Good morning and welcome to the SIA Wealth Management Market Update for March 10, 2020. I am Jeremy Fehr, founder and CEO of both SIACharts.com and SIA Wealth Management Inc. It has been a stressful few weeks for the markets, and I know most of you are looking for answers in all the confusion. So let's take a look at the roots of the market event and where the SIA indicators sit today. The first chart I want to look at is our equity action call. With yesterday's strong negative activity across the world, we saw our equity action call move a little bit lower into the yellow zone. So we moved from a level of 50% on our equity action call down to 41% and change. This leaves us still in the yellow zone, which is a neutral stance from all of our portfolio management and our advice that we give to our clients. This means that you want to be looking for investments that are at this top end of the relative strength markets reports, and avoiding any investments that hit any stop losses, selling those, and then just holding the cash. The asset class rankings, our second level of indicators, shows us that as of March 9th, as of yesterday's close, we have a few more changes in our asset class rankings. Currency has moved from the 6th position all the way up to the 2nd position. This is a significant move because now we have no equity asset classes that are sitting in the top two positions, which are the areas that we do our purchases from. U.S. equity moved down one position, commodities moved down a couple of positions, and Canadian equity moved down one position. One of the biggest reasons why we haven't moved to the red zones is that the currency strength was offset by some of the commodity weakness, our alternative asset classes to equity. So let's take a look at some of the underlying reasons as to why we're seeing this market crisis right now. For many, this crisis has started and been around the coronavirus or COVID-19, but there are many other factors or a couple more factors that I want to highlight on this presentation today. Coronavirus really just exposed an already sore nerve when oil demand dropped. When China had to start to shut down many of its exports and imports, this reduced the consumption of oil around the world by about 4 million barrels. This created a significant problem for OPEC and Russia, who have traditionally been the strongest producers of oil around the world. But the United States, as of September 2019, became an exporter for the very first time and is now competing with those two markets. We saw over the weekend that the OPEC and Russia conversations broke down, which led to an increase in production and dramatic price reduction in crude when OPEC started, specifically Saudi Arabia, started to flood the market with crude. All this is an effort by the other oil producers around the world, more than likely Russia being the leader in all this, trying to knock off and hurt some of the shale providers that are working in the U.S. and exporting energy all around the world. If we look at the price of crude, it is quite dramatic how much of a drop we've had since the latter part of 2018 when we were hitting $75 and change on crude oil. We now drop down to $31.62 on the chart as of yesterday's close on an extremely strong drop yesterday, well over 20%. A close above 36.32 is now needed. So if we look at the chart, we can see at the top of that green zone there that a 36.32 would be probably our first sign of strength after a dramatic drop. We are certainly extremely oversold here. The danger zone for us is that 27.52 at the bottom of the range. We can see that that would lead to a potential drop to some of the lows that go back as far as 1998. So again, this is part of what we've seen around the world. In Canada, we've seen dramatic reductions in ability to export crude, and a lot of this pressure has come from the U.S. expansion with shale, which has largely been debt-driven over the last 10 years. The other problem that I wanted to highlight and really is reflected in both of these charts that I'm showing post world financial crisis in 2008 that ended in the early part of 2009 is really we have a world swimming in debt. So one of the things that we've noticed at SIA is that when the yield gets to the top end of the range, the left chart here is showing us from 1980 all the way up into present, the yield on the 30-year Treasury we can see that it has stayed within a narrow channel for most of that time frame, only a couple of points moving slightly out of it. If we look to what's happened over the last couple of weeks, we've seen that yield now is well below the channel, the bottom level of that channel, and we're wondering if this is establishing a new range. We have industries such as energy within the United States that are very largely debt-ridden, but we know consumer debt is at significant levels in most of the developed world, as well as corporations are in a largely leveraged position today. If we look at 2010, 2011, 2014, and 2018, we can see at the top levels of this yield range that it also corresponds with an equity action call change that moves negative from that point forward. So we can see that there is a strong correlation between the activities of the equity market and where we sit on this yield curve. In 2018, at the latter part of 2018, we saw a market downturn again, and that has been continued up until present, where we've seen that Federal Reserve and other central banks that have been trying to increase interest rates for many years are struggling to find a way to get these interest rate hikes into the market without subsequent equity deterioration. So for many people, this recent crisis has been based on fear of coronavirus going around the world and shutting down markets, shutting down travel. It certainly is having an effect on that. But I would suggest that this is just a situation where the coronavirus has really highlighted a couple of other underlying factors that are much more significant in at least what's happened over the last few weeks. Let's take a look at what the action yesterday had on our largest indicator of equities, our SIA Market Equal Weight Index. As we can look at the chart here on the right, we can see we've moved down to the bottom of the range of a consolidation that started back in 2017. In early 2020, we did see a breakout in January and February, but that breakout is now reversed down right to the bottom levels that we've seen as far back as June 2017. What's important about this chart is that we still remain within that consolidation period. So we're looking for a breakout or a break up from this current level. We haven't broken down. We've had a correction by all accounts here, but I would suggest that any movement below this level would indicate that we are potentially moving into a more bear market status. The next chart I want to look at is the same chart, the SIA Chart's Market Equal Weight Index, but what I'm highlighting here is that the downturn that we've seen, this major correction that we've seen over the last few weeks, really stands as one of four other situations where we've seen as big or bigger downturns in previous years. If we look back at the first chart here in 2011, we have 14 O's of decline. This happened over a longer period of time, so it's much more appetizing, I suppose, than what we've seen over the last few weeks, but it still had 3 more O's of negative movement more than we've seen today, so 6-7% more than what we've seen today. If we fast forward up this chart up into 2016, we see that we have 13 O's of downside in the chart. Again, a bit more downside than that we've seen in the last few weeks. But again, in the context of this longer bull market that started in the early part of 2009, it continued on as a bull market with policy changes from the Federal Reserve and other major central banks, as well as governments around the world in both 2011 and 2016. In 2018, we were rocked again. This situation did not happen as fast. Again, we see some positive movement in that area as well, but we had in total 11 O's moved down just as we've had today. So the significant change between what we've had in the previous corrections since 2009 is that this correction has happened significantly faster. So that's certainly got more people worried and upset about what's going on, but we're faced with the same situation that we were in the 3 previous, that policy changes that we've already seen out of central banks with interest rate reductions, certainly something that the equity markets have favored in the previous highlights that I did in the charts above, as well as potentially what we should expect today is some fiscal stimulus coming from the United States and potentially other global developed countries around the world. The first comparison chart, or the major comparison chart that I'm going to highlight today, is the SIA market EWY from the chart before as well versus the SIA bond equal weight index. As we can see in this chart, it's clearly favoring when we see downward movement of O's. This is when we should favor the denominator, which is bonds in this case. We've moved right back into levels not dissimilar to what we saw in the market EWY in the charts before, back into 2017 levels. This chart remains in a sideways motion over that time frame. We can see that fixed income has been more of a decline since 2017, moving upwards, and we were faced with a situation where a breakout above resistance at that 328 level would have been significantly material to the markets. Even though the market EWY had moved above versus fixed income, we hadn't quite seen that strength yet. So the strength that we've seen over the last year and a half in bonds has really held back the relative outperformance of equities versus bonds. And with the recent downturn in equities, we now are seeing that we've moved back to the bottom of that range. So this is a chart we'll watch for a breakout or a break above. It is very interesting that both the equity chart that we viewed on the slide before, as well as the comparison chart here, are both exactly at the bottom end of that range. So the markets are positioned to either break down or reverse up and hopefully give us a shot for strength above that. The last chart I'm going to highlight today is the US dollar versus Canadian dollar. We can see on the right-hand side here we've been in a column of X's. There has been significant weakness in the Canadian dollar, in the US dollar over the last year and change, where we moved to the bottom of that range down to that 129.83 level. But since this correction started happening a few weeks ago, we've seen the US dollar rally and is now at the top part of the range. This is a significantly important chart for us because that 136.45 level is just below the breakout level of 137.81. We can see that in June of 2017 as well as January 2019, we've tested this level and fallen back. It'll be interesting to see, again, not dissimilar to the previous two charts, which end of the range we come out. So if we see a breakout from here, this would be suspicious towards continued weakness within equity markets as money flows favor the stronger currencies of the US dollar, the European Union, and the yen out of Japan. So with that, that'll conclude our market update today. I just want to re-highlight that there appears to be other factors that are happening right now that have caused the correction over the last few weeks. Crude prices, certainly there's an overabundance of crude that is hitting markets, and some of the players out there are fighting back against the U.S. shale players, which are highly in debt. And certainly weaker oil prices will affect their stock price and their ability to borrow and continue to service that debt on a go-forward basis. Second to that, interest rates. We've seen interest rates for the first time since 1981 break out of a very, very significant channel. It'll be interesting to see if this we create a new trend line with this channel that's there, or will bounce back up or move even further below it over the next little while. But in conclusion, we have certainly seen a rough 3 weeks. Where we go from here is now the most material part about it. These types of corrections are normal. The speed and the severity of it is certainly a shocking factor, but we should console our clients and talk to them about the underlying reasons why this is happening and get their fears away from coronavirus alone and explain to them what's happening within the energy and the interest rate environment today. With that, I will leave you to your day. If you have any questions, myself and my team at SIA Wealth Management is available at your convenience, so please contact us with any questions. Thank you and have a good day.